Hello, everybody, and welcome. This is Intermediate Accounting 17th edition video solution walkthrough for Kiso, Weingen, and Warfield. This is problem 23-2. So the textbook authors of this book are Don Kiso, Jerry Weingen, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. Wiley, all rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky, not the authors of the textbook or of Wiley. Okay, let's go ahead and have some fun. Okay, so we're dealing with cash flows, and this is an indirect method question. So first step, whenever we do a statement of cash flows, is to go through and to create the skeleton. So we're going to go over here. Hinckley Corporation statement of cash flows for the year ended 12/31/20. Cash flows from operations, net cash blank operations, cash flows from investing activities. I just showed this over here as cash flow from operating activities. Net cash provided by operating activities. Okay. Net cash blank investing activities. And remember, the blank is either going to be, if it's a debit balance on our big T account, it's going to be provided by. If it's a credit balance or if it's a negative amount, it's going to be used in. Cash flows from financing activities. Net cash blank financing activities. And so then our total change in cash, beginning cash balance, ending cash balance, and then non-cash transactions. Okay, so our total change in cash here is going to be 33,500 minus 13,000 or 20,500. Remember, my change in cash is the difference between these two balances. My beginning cash over here was 13, so my ending cash is 33,500. So this is our skeleton, and we want to go ahead and make sure that we do this because this is what we're being asked to ultimately go through and prepare. Our next step in terms of going through and doing a statement of cash flows question is we are going to go ahead and we're going to make up the various different T accounts. Our first T account we're going to go ahead and create is going to be cash, operating, investing, financing. And then over here, we're now going to go ahead and do is create the individual T accounts. We have accounts receivable of 10,000. And then over here is 12,250. We have inventory. Opening balance is 9. Ending balance is 12,000. Over here, we have available for sale debt investments. Opening balance of 3, ending balance of 0. We have buildings. Opening balance of 29,750, ending balance of 0. We have equipment. Opening balance of 20,000, ending balance of 45. And we have patents. Opening of 6,250, ending of 5,000. We have our allowance for doubtful accounts was a contra asset account. And then I'm remembering why this problem looks weird, and I'll explain that in a bit. So over here, accumulated depreciation on equipment, 4,500, 2,000. Accumulated depreciation on the building. On the building, it is 6,000 and 0. Okay, accounts payable. Opening is 3,000, ending is 5,000. Dividends payable, opening balance is 5,000, ending is 0. Over here, notes payable, short term, non-trade, opening is 4,000, ending is 3,000. Long term, notes payable, opening is 25,000, ending is 31,000. And then over here, you've got common stock. Opening is 33, ending is 43. And then we have retained earnings. Opening is 6,000. Ending is 20,750. So I just want to kind of make sure that I listed out everything over here correctly. AP, okay. 6, 4,500, 4,500. Okay, and I think this looks good. Okay, so we've gone through and we have set up the T accounts, right? So I've gone through and I have set up all of these different T accounts. Why did I go through and do that? So when I'm setting up the cash flows, I have a very specific methodology that I like to use. My first step is to go through to create the skeleton of the cash flows. So I know that what is my target? Well, my target is I have a change in cash, at least in this question, of 20,500. And my next step over here is to now start going through the additional information. So when we have the additional information, we'll just go ahead and go through it. I like to go through and do this in terms of using journal entries. So if I sell equipment, the journal entry I use to sell equipment is always going to be the same. Loss, balancing, cash, accumulated depreciation, equipment, gain, balancing. Okay, so right over here, my equipment that had cost me 11,000, that equipment was 40% depreciated at the time of the disposal. So my accumulated depreciation is going to be the equipment amount times 40%. Okay, so that's where I'm getting that 4,400 from. So I sold it for 2,500. So that means the equipment had a net book value of 6,600. I sold it for 2,500. So I have a loss, right? I sold it for less than its book value. So my loss on the sale of equipment is basically here, it's going to be 4,100. When I have this transaction, put it in a journal entry, and I'm going to go ahead and post it to the various different T accounts. So over here, my loss on equipment sale, I directly go through and add this back in here. The cash that I receive from the sale of equipment, I'm going to go ahead and put that in the investing section. Okay, it goes right in. And we'll share the nice off orange color. Okay, so we're adding back the loss to net income because that loss doesn't really have a draw on cash. And so that's why we're going through and doing that. My last steps over here is to show accumulated depreciation on that equipment being written off or being deducted of 4,400. And then I'm simultaneously going over here to the equipment itself and taking off 11,000. Okay, so right over there, that is how I do additional information number one. Okay, let's take a look at additional information number two. So 10,000 of the long-term note payable was paid by issuing common stock. So if it's not a matter of being paid, is that I'm issuing common stock and I'm basically reducing my long-term note payable. So over here, so what happens? So if I'm issuing common stock, okay, so what type of account is common stock? Well, common stock is a part of owner's equity. So right over here, I have my assets are equal to my liabilities plus my owner's equity, DC, ER, right? So this is part of my owner's equity. I'm going to show an increase to that with a credit. So common stock is going to be over here for 10,000. For every credit, I need a debit, and I'm going to basically go over here, and this is going to be my long-term note payable. Now, what we see here is that if I go ahead and put this into the various different T accounts, what ends up happening? Well, I've got a long-term note payable over here. And I have over here a common stock going up here of 10. Now, the important thing about this transaction is normally, if we were just analyzing the T account as we would be doing at the end, I could say, oh, well, I got 10,000 of common stock, so I'm going to do the opposite to cash. I'm going to debit, say, proceeds from common stock, and then I pay down a note payable. But the problem with that is this one, is that this involves no cash. So this is something we call a non-cash transaction. So what we're going to do is we're going to enter it into the T accounts. And then the second thing we're going to do is we're going to come over here below the statement of cash flows. And we're going to say that issued 10,000 of common stock in settlement of 10,000 of long-term note payable. Now that language isn't necessarily the greatest, and we would go to sec.gov and happily plagiarize that the SEC wants us to do other people's filings, OPF, but we're not going to go ahead and do that today. We're just going to go ahead and do that like that. So if I have a non-cash transaction, I put it into my T accounts, and then I come over here and I list it out as a non-cash transaction. Number 3, cash dividends paid were 5,000. So if I'm paying a cash dividend, right, there's a whole thing here between was it declared, was it paid, what exactly was it? So more than likely in the prior period, we have dividends payable, and then we have dividends payable, and then we're crediting cash. And if I go over here and I look at dividends payable, if this is going from 5,000 to 0, I have to assume that this was settled for in cash. And that's what it kind of goes through and tells me. So over here, I'm going to go ahead and debit dividends payable, because when I pay the dividend, I'm going to go over here and see, okay, dividends payable cash. And then I'm going to go ahead and do the opposite to cash, or I'm going to credit cash down here in the financing section. This is going to be payment of a dividend. And this is going to be over here for 5,000. Okay. All right. So now that we have that one over there, let's now go to the next one. Okay. On January 1st, the building was completely destroyed by a flood. Insurance proceeds on the building were 30,000 net of 2,000 taxes. Now, what I don't like about this one is that the actual cash proceeds were in fact $32,000. And they shouldn't have shown this net of tax. We'd be dealing with that separately. So the amount of cash that I'm receiving is going to be $32,000. Okay, so if 30,000 is net of 2,000 tax, total cash proceeds would have been 32,000. Okay, again, I don't like the way that's worded, but that's the way the book is choosing to go through and do that. So the building was completely destroyed by flood. So if we go here and look at buildings, we are going to need, if that building was destroyed by flood, we need to take off the related accounts. So over here, I'm going to have buildings. Okay, I'm also going to have accumulated depreciation on the buildings. So my accumulated depreciation on the buildings was at 6,000. The building itself was over here at 29,750. So when I go through and look at this, right, and this goes back over here, do I have a loss or do I have a gain? Well, in this case over here, I've got 38,000 of debits. I've got 29,750 of credits. To make this balance, I'm going to need 8,250. And I'm balanced. Okay, so again, when you get a question like this, best thing to do is to do the journal entry. So now the gain is going to go just opposite of the loss we just saw earlier. Gain on insurance proceeds. Gain on, let's call this gain on building. Again, I would want to talk with my legal counsel to make sure that I'm going through and wording it appropriately. So over here, let's assign this a new fun color. Okay, so I've got a gain on building of 8250. Basically proceeds from building. And I'll go ahead and put this right over here at 32,000. Okay, so I'm going to put this over here at 32,000. And then over here, when it comes to the building itself, I'm getting rid of this amount entirely. And I'm also getting rid of the accumulated depreciation on the building entirely. So it's very important that we take this step over here to go through and to put that into the T accounts. Okay, so that is additional information number 4. Number 5, debt investments available for sale were sold at $1,700 above their cost. So available for sale debt investments went from 3,000 to 0. So based on what I'm seeing in here, this was probably our own only sale. So our cost of these, assuming no fair market value adjustment, was $3,000. So if I sold these, okay, so I've got AFS debt investments for 3,000. Now I sold these for what amount above their cost? I sold these for 1,700 above their cost. So my cash received would have been right over here, 3,000 plus 1,700. So that's how much money I received. So this is going to be a gain on sale of debt investments for 1,700. Now for this piece of additional information right over here, this is additional information number 5. So right over here, the cash is going to go show as sale of available for sale investment. And this is going to be the cash for 4,700. Okay, so right over here, assign a new color. The gain on the available for sale investment is going to be 1,700. And I'm going to make this a nice blue. And here we go. And then lastly, I have to get this available for sale investment off of my books. I'm going to go ahead and credit that for 3,000. So over here, we've dealt with those first couple ones going through additional information through number 5. Okay. Cash was paid for the acquisition of equipment. I'm going to leave that alone for right now, because I just want to kind of leave that and like let that be, because I have to deal with the other information first. So it's great to know. We'll deal with that once we've gone through all the other information. That frankly is very misleading. That's nasty. I just don't say anything. I just say, just assume all other equipment purchases were made in cash. A long-term note for 16,000 was issued for the acquisition of equipment. So this is, again, what's happening here. Well, I'm getting equipment, and this is additional 7. I'm receiving equipment, I believe it's of 16,000. I'm issuing a note. Okay, so this is over here. A long-term note for 16,000 was issued over here. So for this particular one, right, I'm debiting equipment, crediting long-term note payable. Let's go ahead and put that into the T accounts. So over here for equipment, this is going to be for 16. And then for long-term note payable, this is also going to be for 16. Now, again, what we notice here is, oh, was there any cash involved with this? And the answer is no. So similar to additional information number 2, what I'm going to go ahead and do over here is I'm going to go ahead and say we received 16,000 of equipment by issuing a $16,000 note, long-term note payable. Okay, right. So remember, in real life, like in terms of going through and writing out these different items, right? Like how do we describe something? So I just want to, if like on an exam setting, this is really what I'm trying to help you do. But like in real life, what does the Securities and Exchange Commission, what do they encourage us to do? Well, there's already companies that have gone out and made disclosures. So what we're going to go through and do is when it comes to preparing things like, oh, net cash provided by operating activities, we're going to go ahead and go through and, use the language of other people's filings, right? So that's what we want to go through and do. Okay, that's additional information number 7. And then additional number 8 is over here. If interest of $2,000 and income taxes of $6,500 were paid in cash. This is something I typically kind of don't, if we look over here, cash paid for income taxes. So really what I would do is for this particular one, we're just going to kind of go through and say over here, additional disclosures. We're going to basically here say cash paid for interest, cash paid for income taxes. Okay, so it's just additional disclosure on the bottom of our financial statements, and this is going to be 2,000, and this is going to be 6,500. Okay, it doesn't really go in any of the T accounts. Okay, now that we've done all of this, we're now ready to go through and to analyze the T accounts. I'm going to do accounts receivable and the allowance last, and I'm going to show you why. Inventory went up by 3,000. That's why I went from 9 to 12. I do the opposite to cash. I'm going to credit cash. In the operating section, this is going to be an increase in inventory. Available for sale debt investments is balanced. Building is balanced. Equipment. So over here, I need to figure out what is the missing link. Okay, so 20 plus 16 plus X minus 11 equals 45. So over here, this is going to be 25 plus X equals 45. X is equal to 20. And if I put 20,000 here, right, I just want to make sure my math works. 20 plus 16 plus 20 minus 11 is 45. So if you went over here that cash was paid for equipment before you dealt with the long-term note, you would have gotten that wrong. That's why I just basically usually will list out, I'll say on my exams, any excess cash was, or any other equipment purchases were made in cash. So over here for investing, I'm going to go over here and say purchase of equipment, because that's where the purchase of equipment goes. Now for patents, okay, this is also another area that is not controversial, but when it comes to patents, I have 2 different options. Okay, I can use an account called accumulated amortization on patents, or I can just credit the patent directly for the amortization expense. So right over here, I need a credit for $1,250. So I do the opposite to cash, and this is going to be amortization expense. Okay. So with patents, we amortize them. And when we amortize patents, we have 2 options. I can say amortization expense, and I can credit accumulated amortization. That's the way I generally like to do it, just so I can kind of keep track in terms of how much I've amortized my patents by. But the key is, or I can go through here and essentially say amortization expense, and I can credit the patent, okay, for $1,250. Either one is acceptable. So you can also, on the disclosure on your financial statements, you're more than likely just going to say patents net. But the key thing here is if I'm crediting patents, I do the opposite to cash, and this is going to be amortization expense. Leave the ADA behind. Let's go to accumulated depreciation on equipment. 4,500 minus 4,400 does not equal 2,000. I need over here another 1,900. So over here, and this 1,900, this is my depreciation expense. Depreciation expense is a non-cash item. Remember, how do I record depreciation expense? I'm going to debit depreciation expense and credit that accumulated depreciation. So I never call this an increase in accumulated depreciation. That is the wrong answer. Over here, accumulated depreciation on building is done because we sold it. Over here, accounts payable. Okay, so 2,000. Do the opposite to cash right over here. This is an increase in accounts payable. Remember, accounts payable is a liability. It's increase with a credit, decrease with a debit. When I'm going over here and doing this on the T accounts, I do the opposite to cash, right? When I'm analyzing these T accounts, debiting cash, but AP is increasing. It went up from 3 to 5. Okay, dividends payable. Okay, I've dealt with that already. Short term, no payable, short term. So over here, I'm going to go ahead and debit short terms, no payable. Now, this over here says non-trade, so that's kind of indicating to me it's a financing type of situation, right? So if it was a trade, no payable, then you might put it in the operating section. But what we want to say is a pay down of short-term note payable. Okay, so right over here, I'm going to go ahead and credit this for 1,000. Long-term notes payable, 25 plus 16 minus 10 is 31. So I don't have to do anything. 33 plus 10 equals 43. I'm good to go. Over here for retained earnings, the difference here, and remember with retained earnings, my beginning retained earnings plus my net income minus my dividends is going to be equal to ending retained earnings. So over here, what I'm going to go ahead and do is I'm going to call this my net income. Okay. Now we've gone through and have done everything. And when we look at where we are here, and this is what's really messed up. Okay. So with the allowance for doubtful accounts, okay, you would typically, in a real life situation, and I'm going to go here and say 3,000 of 4,500. I'd say, oh, I'm increasing this by 1,500. Is this an increase in the allowance for doubtful accounts? And the answer to that is no. What is that? That is bad debt expense. We record bad debt expense. It's the last step we do when we're analyzing the allowance for doubtful accounts. It's whatever I need to balance this account is going to basically be over here as bad debt expense. But this is not what's happening here, right? So it started with 4,500 and ended with 3,000. Now, when I look at this, I would kind of say, well, this looks like a write-off of an account receivable. But what this question is doing something a little bit different. So what this question is doing, and I'm going to just kind of show you what they did with their solution, is that they're taking accounts receivable net. What does that mean? Well, they're basically going over here and saying, well, accounts receivable net would be what? This would be 10,000 minus 4,500, right? Or 5,500. Okay, so the AR amount less the allowance for doubtful accounts. So that's what they're doing. Then they're going through over here and they're saying that was my beginning balance. My ending balance would be 12,250 minus 3,000 or 9,250. And if I kind of look at this, you know, in its whole, then I would say 12,250 minus the ADA of 3,000. What we would then say is okay, what do I need to do to balance? Well, I need 3,750 to balance. And then over here, I would go and say, all right, 3,750, and this is an increase in accounts receivable net. I absolutely do not like what they've done in this question. I like to look at this as being AR, an increase in AR, and then you would say the other one would be bad debt expense. But this is the way that KISO is solving the solution. So if you get something like this, what I would suggest doing, and I'm going to go ahead and highlight these over here so we know that we're combining them into this account over here for analysis. I would probably do it like this. That's one way you can do it. I'm not sure if I would call this a write-off of accounts receivable, but you could. And you would call that, another way you could possibly argue it is you'd say, well, The increase in AR was $2,250, and you'd have the other one would be a write-off of accounts receivable, because the write-off is not a non-cash item. But this is the way they're trying to go through and to do it. I've more seen things with just bad debt expense. But again, who am I to say what happens here? Okay, so I might be wrong. If I'm wrong or if I'm incorrect, please correct me. Okay, so we've gone through and we've looked at all of the different T accounts. Now what we're going to go through and do, kids at home, we're going to go ahead and add up each of our accounts. And right over here, I subtract the smaller from the larger balance. This is net cash provided by operating activities of 7,300. Next one over here is going to be 2,500, 32, 47, and 20. This is going to be, because it's positive on the left-hand side, is going to be net cash provided by investing activities. And then down over here for financing, you're going to say over here 6,000. So this is going to be net cash used in financing activities. Now at this point, what we want to go through and do is we're going to check our work. So our net cash provided by operating activities was 7,300. Our net cash provided by investing activities was 19,200, and our net cash used in financing activities was 6,000. Over here for a total of 20,500. Does that look familiar? Well, it should, because it's this answer we came up with right over here. So what we're going to go ahead and do now is let's go through and put in the other information into our statement of cash flows. So at this point, what I'm doing is if I've gone through and I've done the various different items. So give ourselves a little bit more room. Okay, when I do the actual statement of cash flows, what I want to kind of remind myself of is that when I do this, if it is a debit, it's going to be a positive amount. If it is a credit, it's going to be a negative amount on the statement of cash flows itself. So over here, okay, so my net cash provided by operating activities is going to be a total over here of 7,300. So come down over here, cash flows from investing activities. Okay, so right over here. So I've got sale of equipment, proceeds from buildings, sale of investments, purchase of equipment. So this is going to be over here. Again, if it's a debit, it's going to be a positive. And this is going to be a negative amount because it's a credit. So over here, I've got net cash provided by operating activities of 19,200. Okay, so cash flows from financing, payment of a dividend, pay down of a short-term note payable. Over here, this is going to be a negative 5,000. And this is going to be a negative 1,000. So over here, net cash used in financing activities is going to be a total of 6,000. When I add up these three amounts, this is going to give me well, not that one, not that blue one over here. Okay, 20,500. So I've made this work and I have my non-cash disclosures, right? This is really why doing the skeleton, and as soon as you see that non-cash transaction, make sure you go through it and write it. My additional disclosures down over here below, cash paid for interest, cash paid for income taxes. So that is problem 23-2. So I want to thank all of this is the magic behind the scenes. It's really exciting, right? All this recording information from Zoom. So right over here, thank you, Wiley. Please don't forget to like and subscribe, right? Those 5-second commercials you can't get rid of. I'm just kidding. I will never force ads. Well, I say that now in May the 5th. It's not May the 4th, be with us, but it's May the 5th. And so I want to thank you for joining me here today. And I also want to thank Wiley for kindly allowing me to make these video solutions. So I look forward to seeing you on the next video. Have a great day.